welcome to Wescott's update on TaxSmart investing. My name is Carrie Delgott, and I'm the Chief Operating Officer for Wescott. I'm pleased to be here with Mark McCarron, our Chief Investment Officer. Welcome, Mark.
Happy to be here.
Mark, let's start out with some terminology. What exactly do we mean by the phrase TaxSmart investing?
Well, essentially, we integrate the impact of taxes when making investment decisions. These include incorporating strategies to limit the impact of capital gains when we reposition portfolios, and when we're looking to reinvest in securities that offer higher after-tax income than others, such as municipal bonds. So tax-smart investing can also involve something called asset location. This simply means that we can create diversified portfolios for our clients while also keeping some of the most tax inefficient strategies, such as those with high turnover, which effectively means loss of trading, or taxable bonds like corporate bonds, and we keep those in tax deferred accounts like IRAs. So Wescott's approach also incorporates something a little bit more proactive, such as what's called tax-loss harvesting. And we do that within separate accounts and across the other mutual fund or ETFs or exchange-traded funds that we hold in portfolios.
So you mentioned tax loss harvesting, and I hear our advisors talk an awful lot about tax loss harvesting. I want to come back to that in a minute. But first, aren't the strategies that you just described rather common across the financial services industry?
Well, these three sort of strategies here that we talked about, you would think that they would be common. But it's important to remember that there are strategies out there for generating either maximum return or even those that are structured to limit downside risk, like the risk of a market decline. And these strategies are really designed with institutional clients like endowments and foundations and pension funds in mind. And these types of clients aren't subject to the same capital gains taxes as individuals are. So as a result, some of those strategies that might look interesting, may also involve a lot of trading activity or use of derivatives, which make them very inefficient, from a tax perspective. Hedge funds that trade on very short-term news or trends are particularly tax inefficient, and you hear a lot about those, but they may not be as efficient for individual investors.
Yeah, tax efficiency, another way of saying tax-smart investing.
Mm-hmm.
So let's get back to this concept of tax loss harvesting for a minute. This is where individual investors are able to use prior investment losses to offset future investment gains to reduce their taxable income. So simply stated, this is when a fund manager opportunistically sells an investment when it has fallen in price, which books a tax loss. Now, to many, this probably seems a bit counterintuitive, given a foundational investment rule is buy low and sell high.
Yeah, no, that's exactly right. And that would be the case if the fund manager or we sold out of a position and held the proceeds in cash, thus selling out low. However, the proceeds from that sale are then immediately and simultaneously invested in another investment of a similar type to ensure that the portfolio remains fully invested in that particular area of the market. Essentially, what we're doing is replacing the original investment with something that just looks almost exactly like it. And, that strategy requires discipline and knowledge, but it can be repeated throughout the year to essentially harvest those losses, which, as you mentioned, can be used to offset any capital gains in the future. And at the end of the year, a portfolio with that strategy employed, effectively an active tax loss harvesting strategy, can produce really strong returns, particularly strong after-tax returns.
So, Mark, how does Wescott apply this tax-smart approach?
Wescott can apply this tax-smart approach across multiple different strategies. So within separately managed accounts, particularly for U.S. and non-U.S. equity portfolios, the active tax loss harvesting strategy we just discussed can be employed throughout the year. Interestingly, volatile markets actually provide a greater opportunity to execute that strategy because of the temporary price declines offer even more chances to harvest a loss in a particular area of the market while also capturing the rebound. In addition, Wescott advisors look for ways to harvest losses across mutual fund or ETF portfolios, and they also look to limit the impact of mutual fund year-end capital gain distributions. But finally, Wescott's Investment Research Group looks for strategies all the time that are naturally long-term focused and tend to have lower turnover when we select investments for taxable clients. And this is a big part of applying a tax-aware strategy.
Thanks, Mark. So as you know, our Wescott advisors, with the help of the Tax Alpha Group, help our clients create a tax strategy that makes sense for them. And Wescott's TaxSmart investment approach is just one component of a more comprehensive plan. As we look to the future, we expect taxes to potentially have more of an impact, making a focus on after-tax return that much more important. So if any of our listeners would like to learn more about TaxSmart investing or other tax strategies, please feel free to reach out to Mark or your advisor. Thank you.
Thank you.